Let's say you open your financial accounts tonight and the total number across everything you own comes out to $1 million. $1 million. That sounds like financial independence. That sounds like you are ahead of the game. But here's what that number often looks like in practice. $500,000 of it is locked inside the walls of your primary home. A house you live in, not one you can sell without upending your entire life. Another $400,000 is sitting in a traditional IRA or 401k, where every dollar you pull out gets taxed as ordinary income. That leaves roughly $100,000 that you can actually access, spend, or deploy without a major consequence. I've been there, staring at a Fidelity login screen late on a Tuesday night, watching a seven-figure number blink back at me, and still feeling that quiet dread in my stomach. Is this actually enough? Can I pay property taxes 10 years from now and still afford groceries? If that feeling is familiar, it is not a sign that you failed. It is a sign that you have been measuring the wrong thing. Net worth, the way most people calculate it, was never designed to tell you whether your retirement is structurally sound. So in this video, we are going to look at 3 specific signs that you are genuinely ahead of most people entering retirement. And none of them have anything to do with the raw number on your net worth statement. The first sign that you are ahead has nothing to do with how much you have saved. It comes down to a single question. Can your guaranteed income cover your fixed expenses? There is a real difference between being wealthy and having cash flow sustainability. A lot of people heading into retirement are asset rich but cash flow poor. They have the net worth number. They do not have the monthly breathing room. Here is the way I think about it. Take every monthly expense that you cannot easily cut, your property taxes, home insurance, Medicare premiums, utilities, any remaining debt payments. Now add those up and compare them to your guaranteed monthly income, Social Security, a pension if you have one, or any annuity income. What percentage of your guaranteed income goes straight to those non-negotiable fixed costs? If that number is below 50%, you are in a structurally strong position. If it is above 70%, you are fragile, regardless of what your brokerage account looks like. That ratio is far more telling than a net worth figure. And here is why this matters so much more in retirement than at any other stage of life. According to the Bureau of Labor Statistics 2024 Consumer Expenditure Survey, housing alone accounts for roughly 35% of total spending for households aged 65 and older. That is before healthcare, food, or transportation. A third of your money gone before you do anything optional. On top of that, property taxes in most states have been rising faster than the general inflation rate. Medicare Part B premiums adjust annually. These are not costs you can skip or delay the way you might have cut a streaming subscription when you were 40. This is where the old 50-30-20 budgeting rule completely breaks down in retirement. That rule assumes roughly half your income goes to needs. But in retirement, many people find their fixed obligations quietly creeping past 60% or 65% of their income, and that leaves almost no margin for the unexpected. Now here is the good news. A 2023 report from PYMNTS and Lending Club found that 60% of American adults still live paycheck to paycheck. That includes 40% of people who earn over $100,000 a year. Paycheck to paycheck at 6 figures. This is not a fringe issue. So if your guaranteed income from Social Security or a pension can cover your fixed monthly costs, and you are only drawing a small amount from your portfolio to supplement, say, at a rate of 4% or less annually, you are already ahead of the vast majority of your peers. Not a little ahead, significantly ahead. Think about what a 4% withdrawal rate looks like in practice. On a $400,000 portfolio, that is $16,000 per year, or roughly $1,333 per month. If your fixed expenses are mostly covered by Social Security and you only need that $1,333 to cover the gap, your portfolio can stay invested and growing. That is a completely different situation from someone drawing 7% or 8% a year just to keep the lights on. The first sign you are ahead is that your income covers your floor, and your savings are there to build quality of life, not just to survive. But what if the very asset you paid off to lower those fixed expenses is actually the thing keeping you cash poor? That brings us to the second sign, and why the standard advice about your home equity may be working against you. For decades, the most common piece of retirement advice you would hear, from neighbors, from parents, from financial magazine covers, was this: pay off your mortgage before you retire. The logic feels right. No mortgage means lower fixed costs. Lower fixed costs means less stress. And there is a real psychological benefit to sleeping well at night, knowing the house is yours. But there is a structural problem with making a paid-off home the centerpiece of your retirement plan. And it is one that very few people are talking about honestly. Home equity does not pay your bills. You cannot buy groceries with a brick. You cannot cover a medical deductible by pointing at your house. Until you sell the property or borrow against it, your home equity is simply a number on a piece of paper. It does not generate income. It does not give you options, and it cannot bail you out quickly when something goes wrong. For years, I used to tell every client who walked through my door that paying off their mortgage before age 60 was a non-negotiable rule. I was wrong. I had not accounted for how rapidly rising healthcare costs and the problem of illiquidity would quietly paralyze their actual retirement lifestyle. A paid-off home felt like freedom on paper. In practice, many of those clients were stuck. So the second sign that you are ahead is this: your liquid, accessible assets make up a meaningful share of your total net worth, not just a small leftover after your home equity is counted. Let me show you what the difference looks like in practice. Take two retirees. Both have a $1 million net worth. Both are 65 years old. Retiree John has $600,000 in his paid-off home and $400,000 in a traditional IRA. His mortgage is gone, and his fixed costs are low. Looks solid. Retiree Susan has $200,000 in home equity. She still carries a low-interest mortgage, and $800,000 split across a mix of Roth accounts, taxable brokerage, and a smaller traditional IRA. Now suppose both John and Susan face the same situation in year 3 of retirement. A major health event. The bill is $80,000. John has to pull money from his traditional IRA. But he does not just pull $80,000. Because that withdrawal is taxed as ordinary income, he needs to pull somewhere closer to $110,000 or $115,000 to net $80,000 after taxes, depending on his bracket. That spike in reported income is not just a tax bill. It can also trigger what is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. IRMAA is a Medicare surcharge that kicks in when your income crosses certain thresholds. A single event like this can increase John's Medicare Part B and Part D premiums for the following year by hundreds of dollars per month. Susan faces the same $80,000 bill. She pulls $30,000 from her Roth account, completely tax-free. She uses $50,000 from her taxable brokerage, which carries a lower capital gains rate than ordinary income. Her total reported income barely moves. No IRMAA surcharge, no bracket jump. She writes the check and moves on. Same net worth. Very different outcomes. The difference between John and Susan is not discipline or intelligence. It is structure. John's wealth is real, but it is locked in an illiquid asset and a tax-deferred account that punishes large withdrawals. Susan's wealth gives her options at the exact moment she needs them most. Now, if you are closer to John's situation, this is not a reason to panic. The question is not whether you have home equity. Most people do, and that is fine. The question is whether your liquid assets give you enough room to handle a sudden, large expense without triggering a cascade of tax consequences. A rough guideline worth keeping in mind: if home equity makes up more than 50% of your total net worth, your retirement plan deserves a close look at the liquidity column. That does not mean you need to sell your house. It does mean that understanding what assets you can actually access, and at what cost, is worth knowing before you need the answer under pressure. The second sign you are ahead is that you have optionality. When something unexpected happens, and in a retirement that could last 25 or 30 years, something unexpected will happen. You can handle it without dismantling your financial structure to do so. So if your liquid assets give you real choices, you are already ahead of a large number of Americans who are holding most of their retirement wealth in a home they cannot easily monetize. But being ahead of the median is easier to claim than it is to measure. How do you actually know where you stand? That brings us to the third sign, and it requires adjusting the benchmark most people are using. Every few months, some financial article will publish a chart showing what the average American has saved by age, and a significant portion of the people who read it will immediately feel behind. But those benchmarks have a serious problem. They do not account for taxes. And for most people with money in a traditional 401k or IRA, that distinction matters enormously. Here is the part people often miss. If you have $500,000 sitting in a traditional retirement account, that money is not entirely yours yet. You have a silent partner in that account, the federal government. Depending on your income and tax bracket in retirement, every dollar you withdraw gets taxed as ordinary income. After accounting for federal taxes, and in many states, state income taxes on top of that, your actual spendable value is typically 15% to 25% lower than the headline balance. So, a $500,000 IRA balance might represent $375,000 to $425,000 of real after-tax purchasing power. That gap is not a rounding error. It is the difference between a comfortable retirement and one that requires careful management at every step. The second issue with most benchmarks is that they measure households, which means couples. If you are single, comparing your savings to household figures will make you feel unnecessarily defeated. So let's look at the actual numbers. According to the Federal Reserve's 2023 survey of consumer finances, the median household net worth for Americans aged 55 to 64 is $364,400. For those aged 65 to 74, it is $409,900. Those are household numbers, a couple combined. But when you look specifically at liquid retirement savings, meaning account balances, not home equity, not business assets, the picture is quite different. According to Vanguard's 2024 How America Saves report, the median retirement account balance for workers age 55 to 64 is approximately $185,000. Let that number sit for a moment. The median. Half of Americans near retirement age have less than $185,000 in their retirement accounts. If you have more than $200,000 in liquid, accessible retirement assets, Roth accounts, taxable brokerage, accessible savings, you are already ahead of the median American worker approaching retirement. Not by a little, by a clear and meaningful margin. And if you have structured a portion of that in Roth accounts or taxable accounts, where withdrawals carry little or no tax burden, your adjusted after-tax net worth is actually much higher relative to your peers than the raw numbers suggest. This is the third sign that you are ahead. When you calculate your net worth using after-tax values, not the pre-tax illusion, and compare that number to a realistic benchmark for your household structure, you find that you are in a stronger position than most people around you. Now, none of this means the picture is perfect. Knowing you are ahead of the median is useful context. It is not a guarantee that your plan is bulletproof. Because the one thing that standard net worth calculations consistently fail to account for is what happens when your healthcare situation changes. And for most people, it will. The average retired couple can expect to spend somewhere around $330,000 in out-of-pocket healthcare costs over the course of retirement, according to Fidelity's 2024 estimate. That figure does not include long-term nursing care. If you are ahead on the benchmarks but have not stress-tested your plan against a sudden large healthcare event, you may be sitting on a vulnerability you do not know is there. Let's walk through what that scenario actually looks like, and what separates the people who handle it cleanly from the people who don't. Let's run a specific scenario so you can see exactly how this plays out. Person A has $800,000 in total net worth, but $500,000 of that is home equity and $300,000 is in a traditional IRA. On paper, $800,000 looks solid. Then a health event happens. The bill comes in at $100,000. A surgery, a rehab stay, a diagnosis that requires ongoing treatment. Person A does not have enough liquid savings to cover it, so they go to the IRA. But pulling $100,000 from a traditional IRA does not cost $100,000. Because that withdrawal counts as ordinary income, they need to pull closer to $130,000 to cover both the bill and the resulting tax liability, depending on their bracket. And that sudden $130,000 spike in reported income pushes them past the IRMAA income threshold. Starting the following January, their Medicare Part B and Part D premiums jump, potentially by several $100s per month, because of that single withdrawal. One unexpected event. Multiple cascading consequences. Person B has the same $800,000 in total assets, but a very different structure. They have a funded health savings account, a portion of their savings in Roth accounts, and enough liquid reserves that a $100,000 medical bill does not require a massive IRA withdrawal. They cover the bill with tax-free money, their reported income stays flat, and their Medicare premiums do not move. Same net worth. Completely different experience. Fidelity's 2024 Readiness healthcare cost estimate puts the average out-of-pocket healthcare cost for a retired couple at approximately $330,000 over the course of retirement. And that number does not include long-term nursing care, which can run $80,000 to $100,000 per year or more depending on where you live. The stress test is not designed to frighten you. It is designed to tell you something useful. If your structure can handle a sudden large expense without triggering a tax cascade, you are genuinely ahead. If this scenario makes you uneasy, that discomfort is pointing you towards something worth fixing. Here is something that does not get said enough in personal finance content. If you have spent the last 30 or 40 years building savings, watching the balance go up, feeling a little more secure each time you added to it, and now you are supposed to start drawing it down, it is completely normal to feel like something is wrong, like you are doing something dangerous. That feeling has a name. Some financial planners call it saver's guilt. For decades, your brain was wired to accumulate. Every dollar saved felt like safety. Every dollar spent felt like a small loss. And now the rules of the game have changed. But your psychology has not caught up yet. I have sat across the table from retirees with $3 million portfolios who were genuinely terrified to buy a plane ticket to visit their grandkids because they could not stomach watching the account balance drop by even a fraction of a percent. The plan was not failing. their psychology was. If that resonates with you, here is one of the most practical steps you can take. Be careful with advisors who charge a percentage of your assets under management, typically around 1% per year. That structure creates a quiet incentive for them to keep your money invested and growing, rather than helping you build a plan for spending it in retirement. Instead, look for a flat fee, advice-only financial planner who can build you a withdrawal roadmap for a one-time fee. That kind of engagement removes the conflict of interest entirely. It gives you a documented plan that tells you what to spend, from which accounts, and in what order, so every withdrawal feels like a decision, not a mistake. True retirement readiness is not about hitting a specific net worth number. It is not about whether your mortgage is paid off. It is about whether your cash flow covers your floor, whether your assets give you real options when you need them, and whether you know, with some confidence, that your financial structure can handle what retirement actually brings. If you found this useful, subscribe to Wes Investor. We publish straightforward, data-backed retirement planning content every week. No hype, no gimmicks, just the kind of thinking that helps you make better decisions with the money you have already worked hard to build.